Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, August 31st, 2022. It is 11:57 a.m. Eastern Time. So I'm starting the video, and what we're going to cover in this one is commodities. So I'll sort of pick up where I left off on the previous video, which focused mainly on the equity markets, but I talked on the impact that commodity prices will most certainly have, or most likely have, on the stock market going forward, due to inflation being really the driving factor right now, the Fed and inflation. So picking that up, if you didn't see that one, you can check that out. But what we're looking at here, this is DJP. Again, one of my favorite broad-based commodity ETFs. Tracks the Dow Jones UBS Commodity Index, and it's pretty well balanced. But like just about every commodity, broad-based commodity ETF out there or commodity index, the ETFs typically will track one of the indexes. It's pretty heavily weighted towards energy, in fact, 40%. So I want to say this as I get into these charts. Remember, although at the end of the day, energy has, to a greater or lesser extent, an impact on just about everything, just about all commodities for the reasons I cited earlier. For example, wheat farmer running the big combines, and everything is energy intensive. Corn doesn't get from the field to the grocery store where you're buying it, in a vacuum. There's transportation fees, energy costs to harvest it, and all that good stuff. So at the end of the day, the world runs on oil. That's it. Let's just not think too much into it. And now, what I wanted to say that too is that this one, and again, this one has probably does have a lower weighting than most of the other broad-based commodity sectors out there in energy, but it's still about 40%. And so remember that although energy prices do to, again, a greater or lesser extent impact other commodities, they can and often do march to their own drumbeat. And so therefore, it is completely possible, and I think even potentially likely, to see energy prices fall, natural gas and crude oil, and then some of these select commodities, especially the precious metals, I'm going to talk on that quite a bit, actually go up. And we'll look at relationships there. So at the end of the day, the takeaway is, and I've always said this, you're going to do better on putting together, if you have the time and the effort and the inclination to put into building a portfolio of, or actively or strategically positioning in select commodities at different points of time versus going with a one-size-fits-all. And I talked about this way back when. I said, look, if you just want to put a one-size-fits-all, this is your guy right here, DJP, for as far as exposure to the commodities sector, or arena, I should call it, arena really. Now, but you can also put a little effort into it and then selectively overweight or underweight or exclude or be long at the same time some of these, and then short others. You have like natural gas, gold, crude oil, Brent crude, soybeans, corn, copper, silver, gas oil futures, soybeans, all that good stuff. And then in that case, you will most likely outperform. It's very simple. You either be long, or bullish, long the most bullish commodities at any point in time, and either short, or maybe that's not your thing, you don't short, so you just leave out the most bearish commodities, and that will help you. If you get it right, of course, it's going to help you outperform a broad-based commodity index. Same premise with the S&P 500. You can buy you'd be easy, just put all your money in the S&P 500 and let it run, or avoid the most bearish sectors out of the 11 sectors in there at any one point in time, and overweight, or only go long the most bullish there. Same kind of premise. All right, so where we're at, bigger picture, make no mistake about it, commodities have ended right after, at the time COVID bottomed, that COVID low in the stock market. We ended a very long and powerful bear market in commodities. And so it wasn't a random thing. It wasn't just the Fed printing money. That certainly exacerbated things, but the charts were calling for the end of that bear market and a new bull market. This one's not marked up. I have other ones. in commodities, and by every single metric there is, we are in a bull market in commodities, and by just about every metric I use, it's not over. It's just the initial leg up, most likely a major secular trend reversal, and so there'll be certainly be corrections along the way, and that's what I'm focused on here. So, to kind of recap, there is a wedge right here. Although you don't have negative divergence, you did have divergence right here. That was a divergent high pointed out at the time. There was our sell signal. We had that big drop with a bear flag in the middle, big abatement in inflationary forces. I spoke to it at the time. We came in on the June numbers, the hottest CPI numbers in 40-something years. Market took a hit. I said that's the wrong reaction. We just had the biggest abatement in inflationary forces, but again, the lag time there is about a month, and so it was. So the market sold off, and then that was a great buying opportunity for us to pivot at the lows. And then, as expected, the narrative changed. The following month, July, we had that drop in inflationary pressures was then factored into the next month in July, but yet I said in July we actually went up. So again, 1 month behind, and so when that came out, that kind of put the brakes on the rally, and that's where we're at. I'm talking about the stock market rally. So we're, so far we're trading about a month ahead of the rest of the world by watching this stuff, and we'll see if it continues to play out. And so from a technical perspective, you have a nice clean uptrend line which has been broken. So that's a sell signal. Yesterday it actually broke, and today's a follow-through red candle. We have a pending PPO crossover, again talked about in the last video. That's when the white line, the 9 EMA, which is the signal line, crosses down below the PPO line. If you don't have a PPO, you can use a MACD, very close cousin, and you look for the bullish and bearish crossovers. If you can't see them here in the video, I'll just put up a histogram that gives you a visual representation of when the lines cross, and let's just take a look at what happened there. So we haven't crossed yet, but you can see from the slope of this line, the histogram's pointing down. Any more downside, we will get a bearish crossover. Last time we had a bullish cross was right here, from red to green. Last time we had a bearish cross was right there. So pretty dang good stuff, right? There was a bullish cross, give us that last leg up. Remember, this was a little period of consolidation choppiness. So you look for these, I like to see what I call these distinct hills. Big green hills. That was a whipsaw there, that red, but that was your final crossover right there. And it said, boom, we went into, again, not correction. We had a correction more in sideways. That's when commodities, that rate of ascent flattened out. We just went sideways to slightly up for a while. There was a bullish crossover right there that preceded that big, powerful trend up. There was a bearish crossover after that initial leg up. We had a nice correction there. So again, pretty good job, and this is, make no mistake about it, that's a big green hill, like a big red hill. This is choppy sideways action. Try to avoid using the PPO. Don't try to extrapolate much useful information there when you're in a consolidation mode. You want to see these trends again, and that's what we are. This has clearly been an uptrend for the last few months here, and so if we get that, that would be downside, a potential swing target all the way down to 31 in DJP, which is that would be a big drop. That would be comparable to that initial leg down there. And mark my words, the narrative is going to change. You're going to hear everybody patting the Fed on the back, saying, "Wow, they really got this inflation thing under control." Again, this is a big if. Let's watch it. This could prove to be a false breakdown. But if we continue to see downside here, got to see crude oil and natural gas break. I'm going to get to those in a second. If that happens, that should be a net bullish thing for the stock market. The only other, the other option or the other alternative is we get that big drop in natural gas and crude, but it's due to the stock market cratering and then demand destruction. Because if the stock market craters and we have that final leg or next leg down to my next long-term targets, remember that's going to be bearish for the economy, bearish for the stock market, and it will almost certainly cause demand destruction in crude, where because the stock market's down, consumer confidence is down, consumer spending is down, and then therefore people travel less and do all that good stuff. Okay, so that's it. Broad base sell signal on the broad-based commodities right now. Let's start with the biggest ones, and we'll start out with crude. USO. Again, I covered this in the last video. One thing to note here is you have this one of my favorite trend indicators, the PPO signal line, the 9 EMA, the white line, because it's the last of the two to cross when it's above. And remember, crude's been in a bull market most of the last couple of years since COVID hit, just boxing in when those lines were above, and then just take those lines. You can see bullish trend, right? There was a correction. This PPO told you. Another leg up, followed by a pretty healthy correction. PPO told you. And then another leg up, right? And recently we crossed and we're still bearish. And then quite often this zero line, which delineates the bull and bear trends, will act as resistance when tested below, especially in a larger trend, just like it acts as support when tested from above in a bullish trend, right? Easy stuff. So based on that, the trend is bearish and we're back testing, so you could make a case for an objective short here. But at the end of the day, we're in this trading range that I showed you in the previous video. We traded around here, had a little false breakout to new highs that got sold into, rejected. We're back in that trading range there. The 200-day moving average down here, especially the red line, the exponential moving average, I'm just highlighting where we've come in and hit it. That's coming in underway. So we have dual support, very good price support around $70, right, give or take, and the 200 days. So a solid breakdown below will most likely open the door for move down, a pretty good drop in crude to come into this uptrend line, which is my longer term swing target, 58.60 price, and the uptrend line right there. Okay, so on that daily chart of USO, crude is above support without any sell signals. This is what it looks like on crude futures. This is in my 6-month, 2-hour candle. So we got 6 months of price history there. You had a nice uptrend line, bearish rising wedge, complete with negative divergence at the high. Said get out or short, especially on the sell signal, which we did. And then we've had this downtrend line, bullish falling wedge right there. And we broke out recently. I put in a small divergent high after the breakout that took us in to back test this. So, you can make a case. I'm standing aside crude. I told you I have a short on natural gas. Right now, I'm just standing aside crude. I'm just not feeling it. So if I'm not feeling something, I'm just going to stay out for the time being. But what I'll watch for, and what you might want to watch for, you could certainly make a case to step in and buy this back test of the trend line because we're coming off a big divergent low. Maybe swing up to that 100.67 resistance slash potential target level, or watch for a failure. If we fail the breakout, especially move down below and double, especially if we can take out those divergences and then those recent lows. Remember, we're going to take out the bottom, so watch that trading range that I showed you. So this could prove to be a false breakout. That would be pretty powerful stuff, and then be the catalyst for that move down in crude. So something I'm watching for. Again, these are all potential things that could happen, and if I didn't think they had a decent chance, I wouldn't point them out. But we have to see them happen. In other words, support is support until unless broken. Here's one of my weekly charts of crude oil. Crude futures. You can see, up around this level here, that seems to be, and then we're going back decades here. This is a 20-year chart. Seems to be about the ceiling in crude oil. And you get these divergent highs. You can see, like we just put in, negative divergence. You had one here. You had a divergent high right here. You had it here. And you can see what happened after each of those divergent highs. So, everyone's talking about crude to the moon, like Russia's always going to be in Ukraine, and that's never going to end. Something sooner or later will change. And again, maybe they stay there and it's just demand destruction. But you can see crude is starting to look pretty toppy here. So you just have to watch those levels I gave you earlier on USO and wait for that sell signal. And otherwise, the uptrend continues, or maybe we continue just grind sideways for a while. And now on to natural gas. This is natural gas weekly chart, meaning every candlestick represents 1 week of trading history. We're going back quite a while here. This is also about I don't know, 20, what did I have? 15 years, 15-year chart price history. And you can see natural gas, well, it's a trendy little sucker. It's either quite often full throttle up or full throttle down. Sometimes it'll consolidate and chop around, but these trends are just super lucrative to trade if you're on the right side of them, and super painful to be in if you are on the wrong side of it. So if you don't know what you're doing, cut your teeth trading, the S&P 500 or Treasury bonds or something less volatile, and then work your way up to natural gas, or trade it. I'll tell you where I think the levels are. Just don't get married to a position. Use stops. And don't let a position run against you. But what I see here is we have a couple things here. First of all, we've been building these big divergences right there. See, I'm drawing the negative divergences that have been building now for, gosh, over well, this is really on the PPO. This is a PPO down here. That's the RSI, the top one. PPO divergences are now have been building since this point right here. This is RSI divergence. They're both divergences, and I don't know if you can see it. I can. No, I can't just pinch zoom. I'm just going to show you there is a nice clean uptrend line right here, right? That's a minor uptrend line. When that trend line breaks, I think we have a pullback all the way here. This is my target right now for natural gas. There's a clean uptrend line off the lows that came right after when COVID hit, and nice price support there at 650. You can see that major reaction high from back in 2013, and more importantly, because more recently, major reaction high from mid-2021 right there. I'm going to measure it for you real quick. Grab my measuring tool. And if so, that's a drop of about 20, nope, right at 30% drop. You get a 30% drop in natural gas, you're going to hear some cheering over there, especially in Europe. Nice relief there, and it'd be a heck of a trade. And again, it's priced in. We just need those sell signals on this weekly chart. Daily chart, let me zoom down to that for you. Okay, here's my nat gas daily. Keep in mind, these charts we're looking at here at the white background, these stockcharts.com, they only give you the EOD end of day, so but there's not much of a change. Nat gas is flat. It's down 0.5% today, so it's about where we are. All right, what you're looking at here, nice divergence. We had a divergent high there, right? Remember that? We had a little short pullback trade on natural gas with that minor trend line break, and it was a big drop, well into the double digits. And that divergent high right there only got larger on this recent thrust up, and there's your new minor downtrend line right there. We're on the verge of cracking it, and so I've been covering natural gas lately. It is technically short because we broke the trend line on the other futures chart I have. We just need to break that price support level. I'll get to that in 1 second. There's my measured target right there from the recent highs, 35% drop. So it's like I just showed you, about 30% from where we're at now. 650 is my target. And the thing about natural gas is when these trend lines break, especially when volatility is high, it's pretty quick. So I can tell you right now, said this many times, I seem to be a lone wolf on this issue. Everyone, all the articles I ever read are that leverage ETFs are the scourge of Wall Street. They should be banned. They're horrible. They're only good for day trading in and out. No, you're going to do better than the leverage factor if you get a unidirectional trend. Unidirectional means nearly straight down fall or nearly straight up rip if you're long. Where you don't want to hold those, and they do suck, is this. That's where the decay happens. I write about that on the FAQ page on the right side of the chart, and it's simple math. And so, in other words, cold, 2-time leverage, if you get a 35% drop from or let's just say 30% from where we're at now, instead of doing 60%, it'll probably give you 100% or more. Because of the way, again, the math works. Too long to explain now. You can read it in the FAQ page. If you don't know where to find that, just drop me a note under this video in the comment section. I'll send a link to that. All right, so that's it. Let me just mark, just because I'm a little OCD this way, that line should be there. There it is. There's our other divergence line. Save that chart. Slide over here. Click save. Yeah, these are clunky charts of stock charts, but they do have some benefits. So I run multiple charting platforms. This is one of them. Oh, before I leave it, one thing to look for too, and it's a trait signature of move of natural gas are these parabolic trends. See these curvy uptrend lines? Those are parabolic lines. Nat gas tends to go parabolic quite often, and parabolic tops never end well or rarely end well. That's where you get these huge corrections, big drops. That one was, well, it's probably 50% or whatever it was. Went from 650 down to almost 350 right there, so almost chopped in half. What I'm going to do for you, let me turn off this. I have to go into annotation mode, and let's see. It looks like we probably have a parabolic run here as well. Just get a parabola tool, go from right here and up to here, and drag that line. Where's the, there it is. See, there's your parabolic run right there in natural gas. I'll click here, grab. Yeah, it's a little clunky, but you can see that. Boom. So you break that, and you could have a very sharp and fast correction. So this is one of my favorites right now. In my book, it's an active trade because I have a partial position, but I told you over the weekend they've shut down Nord 2 pipeline for quote-unquote maintenance, and we heard that quite a bit lately. Said they're going to open it on Saturday. There's a lot of skepticism whether they will or not. And like I said earlier today, it's already, natural gas has stopped going up even with the pipeline shut down. It was only at 20% capacity before. So it seems to me that in most points in time, when you have an event like this, the risks are bilateral, meaning if you're short, you have an equal chance. If they turn it on, the gas is flowing over the weekend. When the futures open Sunday night, natural gas could sink down hard, or if they don't, Russia comes out and says, we're not opening for whatever reason, prices could shoot up. Those are bilateral risks where you have equal chance on either side. It's like rolling, playing the roulette wheel and betting it all on green or red. You're either going to win or lose. But a unilateral risk, if it seems that bad news is no longer bad news, or good news is no longer good news. In other words, natural gas has really stopped going up. That's what the momentum is showing you here. So I think maybe they don't open it. That's already priced into a good extent from what I can read. And so if they so maybe there's no event or very little upside. But if they do open the spigot and start pumping the gas over the weekend, you could see that sharp drop down. That's the way I'm looking at it. It's still a risk, and it's not a complete unilateral risk. It doesn't don't quote me to what I'm saying here, that there's no chance that natural gas isn't going to spike up 10% on Sunday night, because it certainly could. That's the way I see it right now. So that's why I'm comfortable taking a partial short position home into the weekend, and then picking it up when I hear if mainly the charts. I don't care if they tell me the gas is flowing or not. I need to see the next sell signal. Which brings me to the last chart. Been covering this one quite a bit. That next sell signal, as I've talked about here for quite a bit recently, is, let me change up the color of this tool. Right here, this is a 2-hour chart. I'll get to the 1-hour level, might be slightly different. It's about 885 right there. You have this big bearish rising wedge, beautiful little pattern in my eyes. And there's your negative divergence. There's a breakdown. That's why we're short, or I'm short. Sell signal 1, I'll give it to you on the site. And then this sell signal 2, when that breaks, target 1 about 838. Target 2 about 751, and target 3 706. Plus, I give you the levels on the daily chart a minute ago on the weekly chart. Go down to the 60-minute chart. Nope, I grabbed the wrong one there. Hourly. This is the one I've been giving you lately. 929. That's the support level we're dancing on right now. It's a pretty well-defined support level. And we need to take that out. 846, 752 right there, near-term targets. And yeah, here's why, the risks aren't completely unilateral. There's some divergence there, and maybe that divergence plays out, we pop up, and then we put in a marginal new high. But I promise you this, if that happens, I'm going to be talking about that divergence only being extended at the time, and I'll be looking for the next short trade. So that's that. Okay, let's do gold and silver next. Gosh, I could almost cover them in their own separate video, but they're kind of all interrelated, being that they're part of DJP and considered commodities, precious metals, industrial metals. They have all kinds of uses, especially gold and silver. Okay, any discussion, in my opinion, of gold and silver analysis is incomplete without analysis. So the euro, this is E7, euro futures. Big, nice, clean downtrend line right there. big positive AK bullish divergence forming here. This was a major breakdown. That was a major long-term support level I covered at the time. We broke down. There was your breakdown right there. There was our back test followed by a rejection. But these are the levels so far. We put in a divergent low, and these are the overhead resistance levels on this time frame. That's about 101.42, the downtrend line 103.20, and then massive, if we can take that level back with conviction, 104.31. That would mean a massive bear trap, this whole thing, false breakdown, because that was a major long-term support level in the euro, which I will get to right now and show you, even though I've covered it a dozen times. EUR USD, let's go to the weekly chart, and you can see, turn on the levels. Major long-term support resistance zone right here. There was a breakdown. You zoom in, breakdown, backtest, rejection, and very oversold right now. So if we can regain it, and even better, pop that trend line, that's going to be a massive bull trap, big reversal in the euro. What could cause that? Right now, everyone's written the eurozone off for death. You know, poor Germany is dependent, not all of Europe, dependent on Russian gas, blah, blah, blah. Let's just say, you know, whatever things start to improve over there, or for whatever reason, whether, you know, Putin keeps messing with Ukraine or not, let's just say he starts pumping the gas because he doesn't want any pressure from, you know, the rest of the world. That would be a big boon if the gas starts flowing full. And you'd have huge relief, you know, abatement and inflationary pressures over there, would help stimulate economic growth, and all of a sudden the euro could be back in vogue, and, you know, everyone wanting to buy the euro and sell the dollar. So again, I'm just laying out potential scenarios, so we want to watch for that. You want to watch natural gas prices. They go down. So what I'm doing here is tying in potential macro, you know, or fundamental analysis with technical analysis. So, you know, 30+ % drop in natural gas, which would be 35 from the high, would be net bullish, or should be net bullish for a lot of European countries, and therefore should be bullish for the euro, right? So it's all kind of contingent, but the charts are kind of lined up that way, and that's what we need to watch for. So 60-minute chart. This is Euro USD right here. You recently, you know, we're zooming down to a shorter time frame to try to, you know, like this was a trading range that we were in recently. Popped there, that breakout, well, it ran into resistance and then it failed, and then a downside break of that trading range, but it's still, the bottom of the range is still a valid level. We got rejected once, we're running at it again. If they can pop back into it, the MO is usually once you enter or exit one side, you run up to the top. Once you re-enter, just like you fell back in, you went straight to the bottom, right? You entered it here, you went to the top. You went to the top, you went to the bottom. Bang, boom, 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 boom. So if we can do that and then ultimately go on to break above it, you know, again, this is little tick by tick kind of stuff here on the 60-minute chart. And I think I already gave you, yeah, I did give you E7 on the Euro futures. So that's something to watch for. And at the end of the day, and I've covered this many, many times in the past, this video is getting long, so I'm not going to do it now, but I promise you, and you can check on your own, go back 20 years as long as you want. There is a almost perfect, there are times it disconnects briefly, but a very strong positive correlation between the euro and the price of gold, which is the same thing as an inverse correlation between gold and the US dollar. So if this chart plays out that way, that's going to be very bullish for gold. Now gold is, you know, I feel like the old battered spouse thing here with gold. I've been highlighting gold as a, you know, longer term bullish in a bull market for a while, but really nothing's changed. When we go back to my weekly chart here, or was it my daily? Yeah, my daily chart. This is busy, 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 I know, but okay, back I was been a ardent gold bull, long in trend accounts, swing accounts, or trend 401ks, IRAs, all that stuff, but then posted closing all those positions and turn around and shorting gold because we ran into that high was also the previous bull market high from back all the way back here, seeing gold back in 2011, and that started the next bear market. And so it was a natural resistance level. We hit it, then we hit it again. When we hit it, I gave you a buy zone here, that where I plan to scale in for long-term positions, and we hit the top and the bottom of the buy zone there. We hit it there again. We came into the buy zone there. We came into it there recently. Each and every time we bounce, and we're back to the bottom of the buy zone. So nothing's changed. It's still very, very, very even better now. It's 100 times better than back here. If I had it as support back here because of that, we've hit it so many times. Each time you hit it helps to validate that support level. Now, yes, we break it bearish, but I'll tell you what, I'll allow for a little breakdown because look at this. You have strong divergence building on these indicators. Right now, it is a 100% guarantee that if we undercut this, and you would see the sellers come in, that would be all the stops are sitting right here. You'd get a quick swoon down, but then that would be a strong divergent low, especially if we reverse get back in there. That would be a massive bear trap. A lot of shorts would then be squeezed out. However, you don't even have to undercut it. You can just hit it again. Any equal low with the indicators making higher lows is still positive divergence. And it's also, look, we come down a little bit more. Actually, we're back testing now. There's already a back test of the trend line. So this whole thing, I'd buy gold. I'd continue to buy gold as a long-term investor from where we are all the way down to, and allow for a little breakdown, little, I don't know, maybe give it 3, 5, 6% below there, or just wait for the reversal. If they pop it, you want to stand aside and wait to see a recovery back above 158. Then that means the bear trap is effective. But the charts are still constructive. We've just been in a multi-year grind with gold, and mainly what's going on with the dollar and everything else. But again, that euro chart speaks volumes to me, and if that plays out, then that's going to be quite longer term bullish for gold. And until then, we can continue to just swing it within these ranges, based off the technicals. But ultimately, if you break above the top of this range, which is going to entail or really need that bullish snare on the euro I showed you, that whole recovery of those recent lows and a pretty strong rally in the euro, and then that would be good for gold. GDX, the miners are going to follow. Still bullish. I've been highlighting it here. We had this, we had first this wedge right there with divergence, positive divergence right there, and didn't draw it so well. Broke out, and this marginal new low is simply an extension. So the divergences now are even more powerful than they were back here at that last low. We made a marginal new low, and look how much the indicators are building the divergence. They're much higher now, so that's even stronger, larger positive divergence. And this is a new trend line to watch right here because that's where that breakout failed. And so there's your pattern. So everything plays out that way. Boom, we should race up here. That's still T1. Same targets I give you a couple weeks back, couple months back. T1 about 29, T2, T3, T4 initial targets. Oh, and here's one for you. Okay, so the miners have been sucking wind as of late because of soaring energy costs. I've talked about that in the past. In fact, in 2015, I was really bullish, called a bottom on gold in the miners because of the fact that oil prices have been falling. So in orange here is USO, that's crude oil, price of crude oil, and the white is GDX. And what you can see here is when crude starts to drop, there was a big drop in crude right here. Let me color up my tool here. 1 second. Make that big drop. And by the time once the miners realize that, because the reason for this is obviously the miners is very energy intensive. Gold, like I've said 100 times, this isn't 1849 anymore, where gold's just sitting on the top of the creek beds, and you can just go there and pan and grab it all. No, we've stripped the earth since stripped the earth all surface gold. You got to dig deeper and deeper to get it, and that's very energy intensive, requiring big machines that take a lot of fuel, energy, diesel, whatever they're running, electricity at the plants to separate it and sort it and all that stuff once they get it inside. And so, this is a big expense to the miners, just like fuel is a big expense to airlines. And so when you see a drop in energy prices, that's usually quite bullish for the miners. There was a big plunge in energy prices, and I talked about it at the time. It wasn't being recognized, and then the charts set up. So you don't just go long once energy prices drop, but when you've seen a pretty nice abatement in oil prices, and then the charts are constructive, that's when you want to go long the miners, and these things can rip. And so, energy drops, miners rally. Crude drops, miners rally, right? Simple stuff. So if crude drops, like I'm talking about, we've already had a big drop. This big drop in the miners, really, since they peaked right here. Look, it's not mere coincidence. Look when the miners peaked, when crude bottom. Crude's been moving up steadily and strong since, and that's put pressure on the gold mining companies. If crude were to drop, then you would expect, especially because the charts are constructive, a big rally in the miners. Okay, a few more and I'll wrap up here. I threw out lean hogs as a trade idea the other day off this divergent low right here. And I also, that plus it was at long-term support. I gave you the yearly chart, told you it was right there at that 90. This is where we went long. And we already hit my second target. So I got out at that second target. There's a third, but I just wanted out of this just to kind of focus on other things. I do like diversification. And then look, hey, look, we pulled back. You could probably cycle back in for the next leg up. Maybe I'll do that. I don't know. But I just want to point out it hit the first and second targets right there, 92.60 and 93.77. And we're back to trendline support. So we could have another leg up here. I'm just, like I said, with the DJP breaking down. I'm a little cooling off right now on commodities. But again, I will treat them each on their own technicals. And again, we could see just natural gas and crude oil alone come down, and that's nearly half of or more of most commodity indexes. And it is the one thing by far one of the, if not the biggest driver of inflation. So, you could have cotton. Cotton's been going up because of the drought and all that, but that's not going to move the needle on inflation much. It has an impact, but a much lesser degree than energy. So we'll watch energy closely. And then the other ones I gave you recently were I gave you wheat, and that's getting close to that next buy signal here. Let me find the chart for you. ZW. This is a 6-month, 2-hour chart that I showed you before. You have a nice clean downtrend line there. Big divergence has been building right there, and there was a breakout right there, sell signal or buy signal number 1. Then we took out the 824.25 level, and this is the level we keep hitting right here, 851.25, and need to pop that. And when we pop that, it should open the door to the first target there, the next target. That's actually the first target, 917.5, and then 1027.25. Which is the final target there. So that's wheat. And then corn, corn's been going up more so. This is big time play on the drought right now in the U.S. here. But corn, recently I shorted against my wheat long because of this. We ran into big resistance right there. Remember, wheat's coming off a bottom. Corn already broke out and ran, and that's unusual because corn and wheat are competing or almost alternative grains, and they usually track very closely. So here you had a rally. I think corn got ahead of itself, rallied into resistance, and has pretty big resistance there. May power up. The trend is bullish right now, but I think we'll probably pull back here. It's also, I'm sharing this as a hedging trade where you can be long corn against a wheat. I'm sorry, short corn against a wheat long, and I'll show you one other chart here. Okay, for those of you who are still with me at this point, I know it's been a long video. It's kind of a lot of moving parts, and they're all interrelated. That's why I wanted to clump this one together, all these commodities. Corn. This is corn over wheat going all the way back to late 2001, all right? So you can see, if you didn't take my word that they're highly correlated, you can just see this chart. When they go up, they go down together. They go up, they go down together, right? They're both grown in comparable, temperate climates. It's not like coffee, which has nothing to do with wheat, and coffee is grown in tropical climates. So these guys are they're one and the same. And you can make your Wheaties with corn, or you can make it with your Wheaties are with wheat, obviously, and cornflakes with corn. But what I'm saying is they're very similar. And there it is. So make no mistake about it. They move together, right? You can clearly see those correlations. However, look at this big disconnect here recently. Wheat, like I said, got snot knocked out of it, and it's hardly come off that low right here, whereas corn had that big spike up and after a lesser drop. So that's why more bullish wheat than corn at this time for a mean reversion trade. I just want to show you that sharp disconnect recently between the two. All right, and that's it. Those are quite a few trade ideas, commodities, and again, whether you want to trade the commodities or not, I'm a big proponent of being diversified. Spread out your bets. Don't put all your eggs in one basket. But also, again, the impact. If we can keep an eye on that, and some of those scenarios that I laid out start to play out, remember the impact that they may have on what most people might think is completely unrelated, but the equity markets and things like that. So, all right, we're going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.